Okay, in this example, we're going to look at recording transactions into T accounts. So we're going to analyze the transactions that happened May 2nd through May 31st. We're going to determine which accounts are affected, or if they're increasing or decreasing, and we're going to record them into the T accounts. And then after we do that, we're going to determine the balance of each T account. So we're going to start with May 2nd. And it says that Shawn Michael invested $10,000 into the company. So anytime an individual invests into his company, it doesn't say cash, we're going to assume it's cash. Sometimes it may say equipment or supplies, and we would then use the equipment and supplies account. But in this example, we invested $10,000, so we're going to assume it's cash. So we're going to select our date, May 2nd, and we're going to put the $10,000 into cash. Now you notice I put it on the debit side, so it's important for you to remember how accounts increase or decrease. So the best way that I remember is our all accounts, AWE, assets, withdrawals, and expenses all increase with a debit, and then your CLR accounts, like the cleaner, CLR it, capital, liabilities, and revenue all increase with a credit. So you have 3 on each. So in this situation, since he is investing cash in the business, it's increasing our cash. So I have my debit, and then I need to have my credit, because also remember that debits must equal credits for every individual transaction. So if I invest cash in the business, I'm increasing my capital. Capital increases with the credit, so I'll scroll down here to my Michael Capital, May 2nd, and I'll increase it by $10,000. So I have a debit to cash for $10,000 and a credit to capital for $10,000. So my debits equal my credits. So now I'm ready for the 5th. The 5th says that I purchased a computer for cash. So if I purchased a computer, I now have a computer. So my computer account will increase. Computer is an asset and it increases with the debit. So I'll go down and find my office equipment is my computer. And so this is May 5th, and I already forgot $5,000, okay? So I have office equipment now in the amount of $5,000, okay? How did I get that? How did I pay for that office equipment? Well, it says in cash. So if I spent cash, that's a decrease in cash of $5,000. So I have a debit down here to office equipment, a credit to cash. My debits equal my credits on May 5th. On May 7th, I purchased supplies on credit. So similar to the 5th, only I'm buying supplies and I'm not paying cash. So the first thing I'm going to do is I purchase supplies. So I now have more supplies. So my supplies account should increase. And since supplies is an asset, it's going to increase with a debit. So down here for my supplies T account, on May 7th, I'm going to debit supplies in the amount of $600. And then I asked myself, how did I pay for those supplies? And it says on credit. So anytime you see the word on credit, you're either going to have accounts receivable or accounts payable. If I'm going to receive money later, it's going to be receivables. If I'm going to pay money later, it's payable. So in this situation, I'm buying supplies, so I'm going to have to pay for it later. So I'm going to increase, because I'm increasing the amount of money I owe. Accounts payable increases with a credit. So I now have my debit to supplies for $600 and my credit to accounts payable for $600. Debits equal credits. Supplies is increasing and accounts payable is increasing. I'm increasing the amount of money that I owe. Okay, then we have the 19th, says I received cash. So that's kind of the trigger word there. If you receive cash, somebody's giving you cash, so the amount of your cash increases. So I'm actually receiving $1,000 in cash. So I'll go down here on the 19th and increase my cash account in the amount of $1,000. Why did I receive cash? Well, I received cash for programming services performed. Okay, so that's my revenue account. Basically, I have a programming services company. I went out and I performed a service. I helped somebody with their computer, so they paid me $1,000. So that needs to go into my earned revenue account, the $1,000. So I'm going to scroll down here and find my revenue account. Programming services revenue, okay? This account increases with a credit, and that was May 19th, and it's $1,000 that I earned in revenue. Now I just want to point out here real quick, you'll see this unearned programming service revenue. That is not your revenue account. That is actually a liability account. Not only would you have to maybe owe somebody money, but maybe somebody's going to pay you in advance for services that you will owe them. So that's a situation that we would use this account, and you're going to see that here in just a minute. But for May 19th, I've increased my program service revenue account. And keep in mind that your revenue accounts will never, ever, ever be debited for a normal transaction because I can't unearn it. I can't take that away. All right, so the next one. Received cash for programming services to be performed. So that to be performed there is our indicator that they have not yet been performed, but they will be performed in the future. Nevertheless, we still received cash, $1,200 to be exact. So I need to receive or to record that $1,200 that I actually received in cash. And then anytime you receive cash, you ask yourself, why did I receive cash? Well, because I'm going to perform services later. Now, with accrual accounting, which is what you're learning in this class, and the matching rule, we can only record revenue when it's actually earned. So I cannot go down here and put that into my revenue account because I haven't earned it. It says I'm going to earn it later. So at this point, they paid me $1,200, so I owe them. So on May 22nd, I'm going to put it in my revenue account, unearned programming service revenue, $1,200. I owe them $1,200 worth of programming service. So that's how that liability account is used. On the 25th, I paid the rent for May, $1,300. Okay, paid. Anytime you see the word paid, you're going to be spending money, you're going to be decreasing cash. So on the 25th, I paid $1,300. So then I asked myself, why did I pay $1,300? Well, I paid my rent. So my rent, anytime I pay my rent, I'm going to use my account called rent expense. Okay, I paid $1,300 to rent. So I'm going to go down here on the 25th and put in my $1,300 for rent expense. So keep in mind as we go through these transactions, don't lose sight, and it's okay to check, okay, my debit, $1,300 on the 25th equals my credit of $1,300 on the 25th. You want to kind of check that at this point all the way through. Then it says I billed a customer for programming services performed, $500. All right, so this is one of the more difficult ones at this time. I didn't receive any cash. I didn't buy any supplies or equipment, but I billed a customer. If I billed a customer, that means they owe me money. It's just like if you receive a bill in the mail, that means you owe somebody money. In this situation, it's money that's owed to me, so it's money that I'm going to receive later. So we're going to use our asset account, accounts receivable. And they owe me $500 because I sent them a bill. Why do they owe me $500? Well, for programming services performed. So it happened in this situation, I provided $500 worth of programming service, and once I was done, I sent them a bill, and so I'm going to receive that money in the future. So I'm going to debit accounts receivable for $500, and I'm going to credit my revenue for $1,500. So at this point, I have performed all the transactions. Now I need to foot and balance each of the accounts. So footing the accounts means adding up the total debits and adding up the total credits. And then finding the balance of the account means finding the difference between those two. So if I were to add up my total debits, I have $10,000 plus $1,000 plus $1,200. So I have $12,200. That's my footing for my debits of my cash. Then on my credits, if I add those up, I have $6,300. So $12,200 minus $6,300, the difference is going to give me my balance. Now a couple of things to remember as far as what side it goes on. If I take the 6,200 minus the 6,300, I get a difference of 5,900, and it goes on the side that was the largest. So this side is bigger than this side, so the difference will go here. But another thing to remember and a good check is, okay, my normal balance of cash, which is a side it increases with, is debit. So I should normally have a debit balance in my cash account, and in this situation I do. Accounts receivable, if there's nothing to add up, you just leave them. So all of these just had one amount. And then my programming services, I'm just going to add those together. So my balance is my footing because there's nothing on my debit side, nor will there ever be for a revenue account. And then my rent expense, okay? So I've performed all the transactions. I foot and balanced my accounts. So let's click the check my work and see if we've made any mistakes. Okay, so green check marks are good. So we go through and we see that we haven't made any mistakes. And then again, I would encourage you to use this because the check my work feedback gives you some more examples or some more, I guess, explanation of the transactions that you just performed. And then this is always good. Hopefully you found the printouts in Angel that you could print out that helps you talk about how the accounts increase and how accounts decrease.